Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Now let's walk through due diligence steps, red flags, and smarter money moves. Kiosk-only DVD businesses in low traffic or high theft areas. Kiosks look simple from afar, but uptime and location make or break them. Vandalism, theft, and weak nighttime foot traffic will crush payback timelines. Card chargebacks and refunds add more pain. Ask for landlord agreements, security costs, uptime logs, and chargeback rates. If the machine needs constant restock and repair, payback stretches or never hits. Boutique video store revivals that depend on pricey memberships. A charming vibe helps, but not enough to cover rent and labor if the member base is small. High churn, few monthly visits, and limited add-on sales make the math tough. Ask for member churn, average monthly visits, and non-rental revenue like events or snacks. If base rent exceeds 1 month of member fees, risk is high and rising. Franchise or passive income pitches built on fees, not customers. If most revenue comes from franchise fees, kiosk sales, or required supplies, you're buying the seller's margin, not a real business. You need customers who pay and keep paying. Ask for itemized unit economics, audited financials, and franchisee success rates after 24 months. If payback depends on signing new franchisees, pass. If you still consider it, use this checklist and safer paths. If you are still tempted, test the pitch with data, not vibes. The right checks will save you from thin margins and long paybacks. Check unit economics. ARPU, churn, postage, swipe fees, and breakage. ARPU means average revenue per user per month. Line it up against all variable costs, including shipping, packaging, rent or kiosk leases, payment processing, and lost or broken discs. Do not forget refunds and promo discounts. If contribution margin is thin before overhead, the model is not investable. A business that only works at perfect scale rarely works at all. Verify real demand, foot traffic, searches, and local broadband. Ask for third-party foot traffic data near each kiosk or store. Request search trend screenshots for DVD rental and similar terms in the exact zip codes. Pull ISP coverage maps and speeds. If the area has fast fiber and a high share of streaming households, rental demand is weak. Look for proof beyond the owner's claims or handpicked testimonials. Confirm content rights, licensing, and late fee policies. Renting titles without proper rights can trigger fines or forced pulls. Ask to see vendor contracts, studio windows, and renewal terms. Review late fee policies, grace periods, and refund rules. Harsh fees scare customers, but lax rules can erase margin. You need fair, clear, written policies that match local consumer laws. Better places for your money, digital content tools, local event cinemas, retro game resale, authenticated collectibles, library or school media partnerships, cloud storage and CDN plays. These picks focus on repeatable demand with room to price. The message is simple. The market is smaller, costs are higher, and habits have changed. Most DVD rental pitches cannot beat instant streaming, shrinking hardware support, and rising overhead. Use the checklist, demand hard data, and be ready to pass when the math is thin. Put your cash toward modern media tools or community ideas with better odds. If a deal cannot show real demand and clean unit economics, it is not a deal at all. If you want a second set of eyes on a pitch, start with the numbers you can verify. If you ever spot a new DVD rental franchise pitch, you'll know when to say no. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.